Welcome back, everyone. And if you're wondering why you're seeing an orange on the screen, that is because we are going to be discussing all things regarding Orange in New South Wales. Now, this location is a relatively large regional location in New South Wales. It's quite popular. It is fairly close to Bathurst as well, known for its wineries and many more other things. But I want to talk about it from an investment standpoint and what is happening in Orange, and I want to keep you in the loop of is there a possible opportunity here? And like always, I'm going to go through the data. I'm going to go through the economy. I'm going to go through public housing. I'm going to go through an example property that you can also have a look at in this location. Orange is full of potential at the right price point, but it's not exactly cheap either. And so when you start to look at the data, you can see the median buy price is around $740,000. Now, you can buy properties anywhere from $600,000 to around $800,000 where the numbers do stack up, but you do also have to be careful of the cheaper properties around the 500 to 550 range because they may not be in the best housing pockets in this location. So you really need to double check that. Now, you can get yields of around 4 to 5%. I don't really find any properties above the 5% mark. So you're really looking around 4.5 is what to expect if you do invest in Orange. It does have a population of around 40,000 people, which is just on the cusp of what I like to consider, but it's still acceptable. And when you look at the historical price trends, it has been a fairly consistent performer. And over the COVID period during 2022, 2022, 2023, it really did overperform. And you can see that in the latest trend where it has faced a downturn since that time period and has significantly come down. Now, you can see the median buy price in 2022 is about $864,000. Now, it's a little bit small, but you can see that and you can double check it yourself. And now it's sitting around $748,000. Now, for a regional location, this is pretty high already, but there is still room for it to grow. And I will show you why later. And when you start to look at the median rent, you can see it's only about a 1% increase over the past 12 months, which isn't good at all. It's acceptable, but not the best case scenario. We're trying to aim closer to 4 or 5% yield in rent increases per year. Now, when you look at the indicative yield, you can see the yield has been rising. This is mainly because of the prices that have come down since 2022. There's a direct correlation between it. And so you are sitting around that 4 to 5% yields. Now, ERSAT score is around 5 with the rented to owner occupier ratio around 34%, which means it's a healthy level of owner occupiers in this location, which is what we like to see. In a very similar fashion to the rents and the yields, you can see that in 2022, it really started to become a bit more unaffordable, sitting around the 40-year mark. And now, as the prices drop, it's come back down to 35 years, which does fall in our category of consideration. We generally want to be aiming 30 years or below, but 35 is still acceptable for a regional location. And when you look at the data level, you can see that stock doesn't seem to show the best trend. I have verified this across other sources like DSR as well, where I have seen the stock levels come down, and I'll show you another one as well. But you can see that demand is seriously starting to pick up in this location, which is a really good sign to see that capital growth could occur in the near future. And what I meant by the stock levels is that when I looked at SQM research and looked at the total property listings, you can see that during the 2023-2024 period, it really started to flatten out. And now we're starting to see stock levels drop once again. When stock levels drop and demand levels increase, this will likely lead to capital growth. So Orange is really starting to show some early signs of potential. Now, this could change as more data comes in and it could become more popular, generally because that's just the way the markets work in New South Wales and Victoria. We're starting to see if one location booms in a state, other locations tend to boom as well. So it could be very early days, but it could be a chance to jump in earlier into the market. And vacancy rates is sitting about 1.96%. I checked this across SQM research and it's actually sitting a lot lower, around 0.8%. So that is a very, very tight market. So finding a tenant should not be difficult if you get into the market now. And overall, building approvals are pretty low at 0.3%, but I will also mention a project later on in the video that should be aware of, but not a direct concern. And if you guys haven't already, jump into the private community. We have over 300 members supporting each and every single person out, supporting them in the journey, finding the best location to invest into. And we were talking about this location months ago. So you need to be in the community, so make sure you are ahead of everyone else. It is literally $35 a month. It literally costs less than buying a family feast bucket, right? So it is an absolute no-brainer for you guys to jump in the private community, join up, make sure you invest a little bit of money so that when you buy that $1 million asset or that $500,000 asset, you're making the right decision. There is so much value jam-packed in here that you would be a fool not to join. Let's get back to the video. Now, the next thing I do want to talk about is Orange in terms of its economy. And all you have to do is actually start to zoom out and you will notice a couple of things. You can see a pretty big mine down here, and that raises the question, is Orange a mining town? Well, I'll answer that. When you look at Orange's economy, it's about 44,000 people, 23,000 jobs, and a $10 billion economy, which is quite large for a location with only 40,000 people. But it has been healthy with its GRP increasing every single year from 4.2 to 4.5 to 4.7 billion dollars. And the thing you'll notice here is that mining industry makes up the greatest contribution to the economic output, which is about $2.4 billion. And so when you start to break this down by industries, you can see that it is actually fairly diversified into healthcare, retail trade, education training, public administration. 5% of the workforce is in mining. Now, that 5% does give a large portion of exports into mining, essentially, where 50% of the exports come from mining, roughly $2.3 billion, and the rest into manufacturing and healthcare. Now, that does give us a bit of a concern, is that whether is Orange necessarily a mining town? Yes and no. It's not a traditional mining town where 80% of the exports come from mining, but it is still a fairly large portion. And when you look into what it is actually mining, it is basically located in the southwest of Orange. As you've seen, it's an underground mine that primarily focuses on gold and copper extraction. Now, I'm not a favor of particularly going into heavily dominated mining industries, but gold tends to be one of the better mines if you had to pick one out of the lot. And Orange is about 50% mining in terms of exports, but overall, its employment diversification is good. Its exports, not so much. It's a trade-off some investors are willing to make and probably would make that decision. And when you look at why the median price is so high, this could be primarily one of the reasons, because people are on generally higher incomes due to one of the jobs being mining. So it is something to really note that if you do consider to go into Orange, you do need to understand that you are buying into a location that is essentially 50% mining. And I think to have a fair assumption, it is also good to show a comparison, because I always say locations, suburbs, and regional areas should not be viewed in isolation. This is an example where Mackay, as we know, has done extremely well over the past 3 to 5 years. It has seen extraordinary growth. And we can see that mining's exports is about 60% into manufacturing and construction, and it's still a fairly diversified economy as well. When you look at employment, healthcare, retail trade, construction. So it is very similar across to Orange. So if it fits your risk appetite, then you can consider Orange. But if you want to stay clear away from any mining or anything of that resource, then you probably don't want to go here. That is how I see it. But I think looking at a comparison can help you make a decision. Mackay's done pretty well. Our sector is largely mining as well. Orange is in a very similar circumstance, but it's already much higher in terms of the median buy price. But apart from that, Orange does have a couple of good things. It has a very large university, Charles Sturt University. It's got a massive campus there. I'll also list this out, but it's also got a lot of agriculture, fruit growing, which is apples, pears, stones, fruits, and stuff like that. It's also got other TAFEs. It's also got a large healthcare employer, which is the Orange Health and Innovation Precinct in this location. And then it's also got a very large tourism population in terms of a lot of wineries that I actually love visiting as well myself. I love my wines. So it's got a number of things happening in terms of the economy. I'm just trying to weigh up the pros and cons for you guys, so then you guys can make that final decision about whether or not you'd want to consider this location as an investment. Now, in terms of major regional projects, it's got this New South Wales Country Regional Network tender that is happening at the moment. And this has been a $1.5 billion contract since 2011 that you want to look into as well. You've also got a nearby Creeks wind farm, which is currently going major planning, valued around $710 million. Now, this won't have like a huge impact in the economy, in my opinion. Wind farms are one of those things where you set it up, it will have construction jobs in the short term, but then in the long term, it doesn't take too much to maintain them, and it doesn't bring as much local employment, such as like a new healthcare center or an extension of a new healthcare center, or a hospital would, for that matter of fact, or a university. But that is just some of the infrastructure projects that's happening in and around the area, apart from the normal council and local projects as well. So what's an example of a property that you can have a look at? Now, this one here is a 16 Kuranga Avenue in Orange, 813 square meters, 3 by 1 by 1 at $620,000, recently sold in 18th of September. A very nice brick home, very renovated, very, very easy investment that you can hold for a pretty long time. Obviously, a little bit dated in some parts, but overall, a good property. And something like this will set you 620K, which is roughly around $150,000 in terms of a deposit. At 12%, you're looking at around $110,000. Now, when you look at the rental market, you can see properties anywhere from around 550, 570, 580 to 620 in that 3 by 1, 3 by 2 range. And so what I find is for a property like that, I'm getting between 550 and 580 in best case scenarios. And so realistically, you're looking at around a 4.5 to 4.8% yield, which will then leave you around negative $13,000 in terms of cash flow at a 20% deposit. If it's 12%, it's obviously more, but at 20%, it's looking around $13,000, $14,000 after tax, around negative $9 to $1,000 per month or something like that, right? So it's really important to run the numbers and make sure this fits for you. You know, in my opinion, a 3 by 1 at $620,000, you're already fetching a premium for a property, a little bit higher than the median buy price, above some people's price range. If I put this into perspective, you know, a property in Cairns, after all the growth it's had for the past 3 to 5 years, is now valued at $650,000 for a 3 by 1. Orange has come down from its cycle in between 2020 to 2022, and now it's coming back down to that lower sort of price point. It's starting to flatten out, and we're starting to see prices move once again in Orange. So this is an example of a property you can get. So if you don't have this sort of budget around 650, 550 to 650, it might not be the best location for you guys. So please approach it with the right mindset. Now, like always, I look into flood zones, bushfire zones, and generally I can't see any major flood or bushfire issues with Orange, which is a really good site to see. It's probably one of the only regional locations that I can see that is staying away from that. Of course, you might have the storm drainage systems that might flood, so make sure when you buy a property, you're away from that sort of stuff. But overall, the general floods and bushfires, it is pretty safe from. Of course, double check your insurance premiums. If you're buying on the outer edge of this regional location, then it may fall under that bushfire zone. So please double check it. And one last thing I want to mention is that there is this new planning pathway to deliver 330 new homes in Orange called the Redmond Place Housing Precinct. So you can have a research of this online, and at least 20% of these housing will be set aside for affordable housing. Right. And Orange City Council is partnering with Landcom to create a new residential precinct that will increase and diversify housing options for the growing city. The exact details of when this will happen, where it will happen, and when it will be delivered is still unknown. So that really means in the short term, this is not a big issue. In the long term, it could slow down or hinder price growth, especially depending on what price point these houses come at. But at this stage, it's just something to be aware of, but not to necessarily stop you from considering this area in Orange. And that really sums up this location regarding Orange. I think it does have potential, especially with the likes of Dubbo, with the likes of Albury, and with the likes of Tamworth all picking up. Orange was one that was always lower on the radar, and the main reason was because it had a higher median buy price. It was on a falling downtrend, so we needed to wait till it flattened out, and yields have to come up a little bit for investors to see it as an attractive opportunity. And now all those pieces are coming in together where Orange is starting to look possible, because you have to keep in mind Albury Wodonga, even though I think it's a much better location, is now starting to hit the 650 for the 3 by 1 properties. And now in Orange, you can get that same property for 620, 600,000 or so. So it's really important to assess whether or not this is the right location for you. Double check the economy for you, look at the past history, and see if this location fits your strategy, fits your style, and fits your overall long-term goals. And so if you guys have any questions, jump into the private community. That is what we are here for. We will help you find the best location to choose. You don't need to pay $15,000 to a buyer's agent. You don't need to pay $10,000 for a property course. You can pay $35 a month. You can leave whenever you like. You can try it out for a month. You don't like it, you can go away. It's completely fine. It's an absolute no-brainer, guys. Jump in, get the help you need, and then piss off. Till next time, thank you very much.